All right, everyone. Let us proceed. The show, of course, must go on. Mr. Ahmet and I think Davis actually is traveling back to the East Coast, so we definitely cannot leave at a. We definitely can't leave you guys hanging. So here we are today with the market close. Of course, this is the last market close I'm going to be doing. Well, I don't know. Really depends. I'm going to try to fill in those gaps if I can. But this is the last time we'll be streaming until I get back on my vacation in a couple of weeks. So let us get this show on the road. We have a few things we want to go today. We had Jerome Powell talking. He was live. He really was saying some things that I didn't really want to hear as someone who's definitely long the market. We also had Trump do a little bit of talking this morning. I'm going to play a clip from that one. In addition to that, Anthropic fears continue to stream through, but against all odds, software actually is doing pretty good today versus semiconductors, which SOX is down like 4.5%, which is pretty insane. We're seeing a lot of stocks continuing to sell off. I mean, it looked a little bit better this morning, but since then, I mean, it has been a little bit of a monster fall that we had here. Let me go ahead and share this screen, see what we're dealing with over here, see what kind of damage we have. Not looking too great, unfortunately. Oh, we get a little bit of a bounce into close. That's always a good thing to see there. Oh my goodness, trading view, get out of here. All right, so we have SPY down about 44 basis points today. It was actually a lot lower when I looked at it about 15 minutes ago. SPY was down at 629. We have the Qs down about 88 basis points today, so not that bad. It was down all the way to 555 earlier today. We did have Meta. Meta's having a little bit of a green day here, which is good to see. But arguably, Meta's still pretty far down from its all-time high. So not bad to see a little bit of a green day here. We have Google pulling back, Apple pulling back, which is now going to close below the 200-day moving average. So there's like a lot of things we got to look at over here in the market, right? Of course, a lot of things are selling up. When you have things below the 200-day moving average, you really don't get that great movement in the market that we usually see in those rip your face off bull markets. In fact, today we're still getting another close below the 200-day moving average for SPY, same thing with Qs, but Amazon has been well below the 200-day moving average, has shown no means of recovery over here. Meta, of course, is way below the 200-day moving average as well. And Apple is going to have its first close below the 200-day moving average since last August. And in fact, I did post it earlier, but we have AMD, which is looking to make its first close below the 200-day moving average. You can see over here as AMD has dropped down, it's been testing it, bouncing, and you thought it was going to make some recovery over here the other day, and now we're having the first close below the 200-day moving average for AMD. So things are not really looking that good, in my opinion. Semis are definitely hurting. They're just not doing good at all. If I pull up the big chart over here, we have semiconductors down 4.5%. IGV is having a commanding lead here, but on the year to date, semiconductors is still, I believe, green year to date. If I look over here, well, it's about to turn red year to date if it does close around over here. So, gonna hold on a little bit over here, see what's happening. I know a lot of you guys are trying to buy the dip pretty aggressively. For me personally, I'm not trying to buy the dip aggressively in like a short swing term, swing trading portfolio. But I did start the portfolio up where I am slowly dollar cost averaging into the market, into a bunch of names that I do find pretty favorable. One of them, of course, is Amazon. Another one is Mercado Libre and a few other names. I'll probably be posting that one on Twitter, but that's going to be like a very slow DCA buy, not like throwing 10% of the portfolio in somewhere, throwing 6% portfolio in something like that. This is going to be something that I'm going to start for a long period of time because personally, I don't see a way out of the situation. I see that the situation getting a lot worse. We are down about 10% from all-time high. So I think that for this to continue accelerating downward, we need to see a continued escalation. But I mean, you had some commentary that I'm going to play a little bit from Jerome Powell, which doesn't really bring a lot of confidence here. You have the S&P still trading at pretty excessive valuations here, around 20 times forward. I think it's about 20 times forward. It was like 22 times forward the other month. And, I would say that, dollar cost averaging to the market for a long period of time is something we continue to do so. Obviously, you guys have your 401ks, your IRAs, and so on. So you've already been doing that. Maybe something a little bit more concentrated is what I'm going to be looking at doing with a few names. I'll keep you guys posted on that one. Let's take a look at the Fear and Greed Index. Someone did mention this one earlier. Let's see how this one is looking over here. I barely look at the fear and greed index because I know this thing is going to be broken especially when we have a massive pullback. We're at an 8 over here. Okay. So one thing to remember with the fear and greed index, guys, is that this is very technical based. This isn't like sentiment based, like the AAII sentiment survey. This is more technical based. You have the stock price breadth with net new 52-week highs versus lows, and that's on the New York Stock Exchange. This, of course, is falling down, especially with semiconductors pulling back quite a bit here. You have below the 125-day moving averages. This is actually going to stay in extreme fear over here for quite some time, as long as we continue to trade below 6,800 in the SP 500. Stock breadth continues to be pretty bad over here as everything continues to fall. Put and call option ratio. This one's going to be pretty volatile depending if we get a bounce or not. Like if we get a pretty strong bounce in the stock market, then this, of course, will probably pull back here, and you're going to start to get a little more optimism in the put and call option. VIX is at $30, so we need to have some sort of really good news to see VIX come back and compress down. But VIX has been trending up for quite a couple of months lately, so this will continue to stay up there. Safe havens, 20-day stock and bond market returns. This is actually a weird one because we do have TLT up about 1.25% today, so that is going to outperform, of course, the stock market as it is a whole. Junk bond demand. I mean, let's be honest. If the 10 years at 4.5%, no one is really going to want junk bonds right now. They're going to stick with the investment grade. So that really is your companies that are producing a lot of free cash flow and producing a lot of profitability to the bottom line. People are probably staying away from the junk bonds right now. I don't think anybody wants to sell debt to loan debt to Beyond Meat or anything like that. Obviously, that's not where the junk bonds are, but you can understand there's a bit of fear in the market. There's a bit of uncertainty. Usually when this happens, nobody wants to put money in companies that might go belly up in a couple of years. So we will see what happens with that one. All right, let's get on with the first clip of the show today. We did have Trump do a little bit of talking as far as where we're going. I mean, I'm going to collect all the headlines that I did see this morning and show you guys a few of those. But, you look at the stock market, clearly there hasn't really been that much good news today. So I'm going to play this for you real quick.
Talking about the war with Iran, thousands more U.S. forces arriving in the Middle East. We're talking about more than 3,500 troops, including 2,500 Marines newly arrived to that region as the war enters month 2. Now, this troop buildup only intensifies attention to that messaging that seems a little bit mixed from the president. He voiced optimism about talks with Iran and then issued new threats to Iran's power plants, oil wells, and Karg Island.
Are you considering still putting boots on the ground, and would you do that without going to Congress?
I just have lots of alternatives. We have tremendous numbers of ships over there. We don't need them all because of, the power. Look, I would say we're just like we're ahead of schedule on the ballroom. In a much bigger way, we're ahead of schedule with Iran.
So earlier, the president told the Financial Times he may send troops to Karg Island to, quote, take their oil, but acknowledged that he would also mean the U.S. would have to be in Iran for what the president said was a while. Meanwhile, the White House has not denied a Washington Post report the Pentagon is preparing for weeks of ground operations. Of course, Iran has said if the U.S. launches a ground invasion, it will step up attacks on U.S. allies. Case in point, you see that right here. This oil refinery in Israel is the latest target of Iranian strikes. So live now to CBS News Pentagon reporter Eleanor Watson. So Ellie, what can you tell us about the arrival of those troops in the region?
Yeah, Reed, even as the president is pushing for those negotiations, thousands of Marines arrived in the region over the weekend, and we reported this morning that hundreds of special operations forces are now there too, with more U.S. troops on the way. This is all to give the president options if negotiations fail. Those options could include things like reopening the Strait of Hormuz, seizing the highly enriched uranium from deep inside Iranian territory, or capturing Karg Island, which, as you mentioned, the president has been threatening. Karg Island is a crucial hub for the export of Iran's oil. About 90% of Iran's oil is exported by going through that terminal where the oil is loaded on tankers. Destroying the oil infrastructure on that island could have wider consequences for the economy, so capturing it is another option the U.S. could pursue. But we should note that island is just 15 miles off the coast of Iran, so even if a mission is doable, the troops there would risk threats from cruise missiles, from drones, from fast attack speedboats, and likely risk more casualties.
Yeah, right. Well, let's also talk about some recent hits. Of course, attacks on Israel by the Houthis of Yemen, and NATO forces, we understand, intercepted a missile that targeted Turkey. Are we at the point where these hits not only signal maybe an escalation, but also more of an expansion of the war in a regional sense?
Well, the ballistic missile that apparently targeted Turkey, that's now the third missile that Iran has launched towards Turkey that has been intercepted by NATO forces. That's concerning because Turkey is a member of NATO, and if there were to be a successful attack, that could require some NATO military response with other allies. But so far, Turkey, through those different interceptions, has not shown any indications it's leaning towards invoking that clause. Now, to the south, in Yemen, the Houthis, which are backed by Iran, entered the conflict for the first time since it started by launching this missile towards Israel. They have...
All right, so that's a little bit of an update we have for you in the market. We're probably going to see some stuff happen after close here, as we have seen for a long time. The markets are bouncing a little bit over here, which is really good to see. We're going to be closing in about 3 minutes over here. We're getting a little bit of a bounce at the close. I did notice that SOX is kind of recovering over here, but still not looking good over here for the SOX ETF. Qs are down over here. Let's take a look at some individual stocks real quick into the close. Yeah, Nebius is down here at 92 bucks. This is pretty interesting because we literally undid the entire move. We undid the entire move that we had after they got the deal announced from, was it Meta? I forget the company that announced the deal with Nebius. But we undid that entire move, and I still remember all the way over here, guys. People were getting very excited, trying to buy Nebius. Steve and I said, look, you can get better prices, and here we are today. You're getting better prices at Nebius. IREN is all the way down at $31. Holy cow. We have not seen these prices in IREN since back over here, September. But I do remember that time we had, it was back over here, beginning of March, I believe. We had IREN report its earnings. It was like below $30. But here we are again, guys. So, you know, I'm not going to be like, everyone load the boat. This is the bottom. We're going to go higher from here. It's very difficult to know where the bottom is. I mean, this is a falling freaking knife in the stock market. Like, how do you know where the bottom is? Like, we're below the 200-day moving averages over here, right? If I look at the weekly chart, it looks like we're going down to 533 on the Qs. If I look at the monthly chart, it looks like we're going to be going down at least to 545. Like, we are in no man's land. Well, not really no man's land, but we're in a place where it's just going to be extremely volatile, guys. The VIX is at 30. The VIX is above 30 right now. You are going to see massive chop in the markets. Don't get ahead of yourselves when you start seeing green candles. Wait for some clarity for things to happen. Now, with that being said, like I mentioned earlier, dollar cost averaging for me makes sense here. You got to see what your goals are and everything. But like when I'm talking about dollar cost averaging into the market, I'm talking about a slow dollar cost average into a bucket names, and I am very bullish on for the long term. And this is money that I don't need for at least 20, 30 years, right? So that is what I mean by dollar cost averaging. Look at this as like your 401k, but more like being strategic and tactical with certain positions. I do have a 401k as well, and I don't max that out, but I do have that as well. So like if you're already doing 401k, you know, why not put some investments toward the future? With that being said, the market is closed today. We have the Qs down about 32 basis points, a little bit of recovery there, which is good to see. Still on the daily chart, the Qs is still below the 200-day moving average over here. We have, sorry, did I say Qs? I meant SPY. We have the Qs down 76 basis points lately. Oh, yeah, good call on that one. I'm going to bring up, someone did say recession's incoming. I mean, I don't know. We'll wait and see. We're going to listen to a clip with Trump and see what happens over there. Yeah, but I wake up, I buy Amazon. Well, congratulations. I mean, Amazon had a pretty decent day today. Amazon was up about 81 basis points today. Meta was up about 2% today at 536. Was crazy. I thought we were going to see below $500 in Meta. We did not see below $500. Netflix is staying pretty strong here, even though it's down 50 basis points today. It did not give up any of the gains it had since that WBD deal did fall through the cracks there, but arguably good for Netflix. I mean, that's a free $2 billion right there from doing basically nothing, maybe some litigation fees and all that stuff, but they got $2 billion right there. We have Tesla down 2% today. this is starting to get pretty interesting over here because it's coming back all the way down to where it was last July. I'm not buying Tesla over here. I don't plan to buy Tesla here. If Tesla does come back down to, I would say, the low $200 range, I might consider starting to DCA into Tesla. The big portfolio, no moves for me. Well, I lied. I did sell a position today. I did sell my Marvell position about break even, but I did open that one up about 2 weeks ago. And the reason why is because when you have the market pulling back, I don't want to be back holding certain things that I just entered, right? So I'm going to wait and see what happens for clarity before I start adding and start aggressively trading the market. Right now, still trying to hang out a little bit and see what's happening. What is going on? Evan, my man, Stock Market News is in the house. Largest financial account on Twitter. A lot of you guys probably know this is. Thank you very much for being here, Evan. Let's give a like and subscribe on the channel, especially if you are on the YouTube channel for Wolf. Guys, by the way, Gab Blacksburg did an interview with Chris Camillo, and that was just released this morning. I'm going to pull up that. Video here. And I'm going to share that with you guys because I cannot wait to check that out. I have a 13-hour flight coming up later today, and that is not going to be a fun one. I take off about 7 hours, so I got a little bit of time. But this is the interview with Chris Camillo and Wolf. So go ahead and check that one out, guys, when you get a chance. It's about a 40-minute interview, so you can go ahead and listen to that one, see what he has to say. But remember, Chris Camillo is the guy who turned $20,000 into, what was it, not $70 million. But that did not happen overnight. So don't listen to what he's long and go all in those stocks. You don't think it's going to happen like tomorrow or something. Like whenever I listen to these kind of interviews, I always try to take away their strategy and how they think more than just like getting some fish in them, right? Learn how to fish. Don't give a man a fish, he'll live, whatever the quote is. Teach a man to fish, he'll live for a lifetime. So that is what it is. Yeah. Why did all the AI stocks sell off? Well, all the AI stocks sold off because the ones that were leading the market up for a long time is down 4.25%. SOX. All right. So what is in the SOX ETF? Well, let me pull up the Seeking Alpha over here, and I'm going to pull up the SOX ETF in Seeking Alpha. Let me share that for you guys. So if you look at the holdings here for SOX, you have 9% Micron. Micron is down 10% today. You have 8%, 7% Applied Digital. You have 6% NVIDIA. You have 6% AMD. You have 5%. This is all the stocks has been leading the market up. All of them have been leading the market up this year. And when those stocks pull back, when Micron's down 10%, when Applied Materials is down almost double digits, when NVIDIA is down 3%, this whole ETF is going to go down. And when most of the market has been propped up by a lot of semiconductors and those fall, the market will fall. So you got to remember the S&P 500 and the NASDAQ are made up of a basket of stocks, but it is weighted based on market cap. And if everything pulled back, but the ones that were leading the market, and then those pull back, you're going to have a massive fall in the market. And that's really what we've been seeing for the last few days. We've seen a lot of deleveraging of these leaders in the market, namely NVIDIA, Micron, AMD, Applied Materials, all these companies pull back dramatically. And that has been a catalyst for the market to come down even further. It's a lot of deleveraging. And unfortunately, we are not seeing a bounce in the market right now. No bounce. I thought maybe we were going to get like a little bit of a bounce today, considering that things were green last night. It all sold off. It all sold off this morning as soon as the market opened. If I pull the 30-minute chart over here, and let me hide this stuff. We had the market open here today, 9:30 a.m., and it just got sold off. We haven't even seen the opening prices since the market opened, right? So usually whenever that stuff happens, like you got to kind of be careful trying to call bottoms here, right? Calling DCAing or dollar cost averaging takes away the guesswork of calling the bottom. That's why dollar cost averaging makes sense for a lot of people, because you don't need to look at chart. Well, it makes sense to look at charts and everything, but you don't really need to pay attention to the intraday moves in the market, even the weekly moves in the market. You're going to buy at a set dollar value every X amount of weeks, days, months, whatever it is. until whenever, right? You take out the guesswork of thinking like when the market's going to bottom, you're just consistently buying, and then your total size of that position is going to be an average of all of those buys you did. A lot of people did this with Rocket Lab. Speaking of which, Rocket Lab is all the way down here. Not all the way down, but it was down about 6% today. So Rocket Lab, I would be honest, is going to get very interesting if this thing gets all the way to like below like 40 bucks. Going to be very interesting for Rocket Lab. I'm not going to buy here though. I think the market is still getting a lot of bad stuff going on. Wow, Hims is almost fading the entire move over here. Lemonade is back in the $50 range. Oscar, did that go below $10? It did not go below $10. Peloton, be very careful with Peloton, guys. Don't get too bold up in Peloton. You need to look in those financials. I was long Peloton and options, and I stopped myself out when I was like around $8 or something. I didn't really lose any money in that one, but that was like a very small position. But like, you have to be well aware of the risk when you're looking at Peloton, okay, guys? Like, yeah, I mean, I use a Peloton. I got a Peloton like right there, but I ain't gonna buy the stock right now. Like, this thing can easily go private at a massive discount. And if it does, that is not going to bode well for their stock. And, you know, they do have a lot of assets in their business, but they can easily sell off those assets in order to stay afloat. So you got to be careful with stocks like that. Don't get bold up if you see someone on Twitter getting very bold up. Do your own research for sure. I saw news after hours that Vert signed a contract, and it doesn't even appear that it's making a move on it. Let me actually pull up that stuff with Vertiv Holdings over here. We have here that Vertiv Holdings. I'll share this one. We have over here that Vertiv invests $50 million to expand AI data center cooling capacity. $50 million. Okay, so they're I thought they got investments. They're not. They're investing in something. So that pretty much is not really that good. That news that's going to make the thing pump up. All right, guys. So I have another clip I want to play. Obviously, Powell spoke earlier today. I don't think it was really anything like he said something that we didn't really know, but he's kind of giving his thoughts. Powell's last FOMC meeting is the next one. So I don't know how much sustenance that the market's going to put on what he's saying, but let me go ahead and play this for you. This is a 2-minute clip. I also do have another clip I'm going to play for you after that one. I wish I found like the whole clip over here, but I couldn't find. Maybe I could find the whole clip while I'm playing this one. So I'm going to go ahead and play this one for you guys, and let's see what he had to say today.
The current crisis in the Middle East and the effect on energy prices. Indeed, this classroom is familiar with that question from the last problem set, where we asked, how would you advise the Fed to respond to the rising price of oil? And we teach that when there's a demand shock, that's a pretty natural set of recommendations that emerge for the Fed. But when there's a supply shock, like this energy price shock, there's trade-offs that the Fed has to juggle. How do you make those trade-offs in general, and how do you make those trade-offs in this particular instance? And can you help everyone with their piece?
Well, maybe they should tell me. Sure. So you start with what you said. You know, our tools work on demand. Higher rates will tend to moderate demand. Lower rates will tend to stimulate demand. And when you have a supply shock, our tool doesn't have meaningful shorter-term effects on supply. So when you have a supply shock, the first question is, do you respond to it? And the classic question has been around energy, just in general, not really speaking about the current situation, although I'll get to that, I guess. But, you know, energy shocks have tended to come and go pretty quickly. Monetary policy works with long and variable lags, famously. And so by the time the effects of a tightening in monetary policy take effect, the oil price shock is probably long gone, and you're weighing on the economy at a time when it's not appropriate. So the tendency is to look through any kind of a supply shock. But a critical, essential aspect of that is you have to carefully monitor inflation expectations, because you can have a series of these supply shocks, and that can lead the public generally, businesses, price setters, households, lead them to start expecting higher inflation over time. Why wouldn't they? At the end of a certain number of years, the inflation is now just higher, and that can happen. So you monitor that very, very carefully. Also, in the current situation, you have to be mindful of the whole broader context. And the broader context is we're still, we've been coming down close to 2% post-pandemic, but we've never actually, gotten right and stayed at 2%. So it's been a while. And we're very mindful of that fact. Inflation expectations do appear to be well anchored beyond the short term, but nonetheless, it's something as we will eventually maybe face the question of what to do here. We're not really facing it yet because we don't know what the economic effects will be, but we'll certainly be mindful of that broader context when we make.
All right, so he didn't really give too much context at exactly what we're doing. I think that the going thing here, actually, I have a bunch of notes here that someone posted from the Powell interview. Let's actually go over this one together. So we have that he spoke at Harvard for his final appearance as Fed chair. He definitely said, all right, so Federal Reserve will not cut interest rates this year. A rate hike is still on the table. Inflation must come back to 2%. And that will not change. See, this is an interesting one. I mean, this should not be news for anyone because if you look at the CME Fed Funds Future, let me actually share that one over here. This is the CME Fed Funds Future. You can basically see the probability of whether we get a hike, whether we pause, or whether we get a cut throughout each term. If you look at December 2026, this is where rates are expected to be at by the end of the year. And you can see here there's a 78.6% chance that the Fed is not going to cut at all this year. One thing you got to remember, guys, is that whatever the probability of this is going into the FOMC event is going to be what the Fed's going to do. There's a very high likelihood they're not going to stray away from this. But this is a volatile chart, right? So 1 month ago, we had about a 30% chance of getting 2 cuts. Now we have a 78% chance of getting no cuts. So that's something you need to be mindful. And Powell's not going to go up there on the podium and he's going to be like, hey, guys, we are going to cut rates this year. Hey, guys, we're going to cut, because he doesn't know what the probability is going to be. He doesn't know what his cabinet's going to say. He only knows what he is going to say for the next meeting. And clearly he is not someone to start to throw banter out there that's going to move the markets. He's trying not to move the markets. That's really his job, to reduce the volatility. U.S. debt levels are manageable today, but debt is growing much faster than the economy. That's very true. We saw that with the Trump pivot last year. Federal Reserve must stay completely free from political pressure. All right, well, let's see that. Let's see how that works out. The U.S. banking system is much stronger and safer today than it was in 2008 crisis. Artificial intelligence will eliminate some jobs, but will also create new ones and improve living standards over time. I actually did talk about this one during the meetup. By the way, it was great to see everyone during the meetup last Saturday. Also, people who are around on Friday as well. Honestly, I apologize if I was talking to you and I had no idea who you were, because I've been talking to you on Twitter. Like, there's this dude, Austin, who I've talked to a lot on Twitter. And the whole time that he was there, I was talking to him and I didn't even realize it was him. I thought it was just some dude named Austin, but I guess I should have clicked on the profile photo and saw who that was I was talking to. Anyways, really appreciate meeting a lot of you guys over there. Looking forward to the next one. Anyways, Powell did say he is very optimistic about the long-term future of the U.S. economy, but it says right now is genuinely difficult for young people entering the job market. So I'll get a little bit of my commentary over there afterwards. I did want to play another clip over here. This one's significantly shorter, but in this one, actually, this one is from Fed Governor Stephen Moran. I don't want to play the whole thing of this one because he is the dissent, meaning that he has been calling for cuts. So he's definitely more dovish when it comes to the Fed. But let's see what he has to say. This is actually a 5-minute one. I'm not sure if I'm going to play the whole thing, but let me just play this clip for you.
Has been dissenting in favor of bigger cuts at recent meetings. Fed Governor Stephen Myron joins us now for a CNBC exclusive. Welcome. Good to have you.
Good morning. Thanks for having me back.
Has your view changed at all as a result of the rising oil prices and diesel prices and fertilizer prices about the outlook for inflation?
Yeah, so traditionally the Federal Reserve looks through an oil price shock. Now, the reason why we do that is because oil price shocks tend to boost the price level immediately. They flow through into prices very quickly. Gas prices move higher. But monetary policy only hits the economy with lags. It doesn't, if you change monetary policy today, it doesn't affect economic growth. It doesn't affect unemployment or inflation for 12 to 18 months from now. Right? So if the oil price boosts the price level today through the gasoline price and other things, but not 12 to 18 months from now, monetary policy simply cannot affect that. Now, the way that wouldn't work, that this traditional logic the Federal Reserve has always observed, the way that this logic would not work is in one of two scenarios. One is you get a price wage spiral where wages start moving higher and then prices start moving higher too. There's not really any evidence of that thus far at all. And with the labor market on a gradual cooling trend for the last 3 years, that seems extremely unlikely. The other way that you would get the oil price shock boosting inflation 12 to 18 months out is if inflation expectations started to get affected. And when you look at the inflation expectations, you don't really see that. So I like to look at CPI swaps. CPI swaps for the next year moved higher because prices move higher immediately, exactly as we said. But when you look at forward rates, when you look at inflation expectations, 1 year forward, 1 year, 2 years forward, 1 year inflation, 3 years forward, they haven't budged. And when you look at medium to long-term inflation expectations, like 5 years forward, they've actually been coming down since this entire thing started. So in order to get an inflation shock from oil that the Federal Reserve can affect, it needs to affect inflation beyond a 1 year horizon, and there's thus far no evidence.
All of that is true, but you know, there was evidence, first of all, that the Fed's inflation target was higher. I mean, that inflation was higher than the Fed's target going into this, right? And that what this will do is, even if it's in the short term, will have an impact on headline CPI, on PCE, you know, the longer this lasts. And it's now, what, we're 5 weeks in, and there are concerns that it will have a bigger impact on underlying inflation, even if you're not seeing it necessarily in those expectations or wages.
Yeah, so if I saw one of those two things happen, if I saw a wage price spiral or I saw evidence that inflation expectations were starting to pick up, then I would get worried about it. But as I said, there's no evidence of it thus far. And you can move the monetary policy rate all you want, you know, today, tomorrow, but it's not going to affect inflation in the next couple of months, right? It can only affect.
All right, so it's not a whole lot of ways to say. Obviously, he's going to shoot for lower rates. He's going to try to talk down inflation and stuff. But I don't know. The market's kind of looking at this, and they're not really getting bulled up. You really got to have the Fed chair up there to see what's going to happen. As a matter of fact, actually, Kevin Warsh is going to be voted on the Senate committee coming up very soon. Actually, I think it's as early as April. Warsh vote Senate. Let's see here. We'll hold up Senate vote. April 13 is when they're going to vote for him. The committee hearing was delayed as potential around the week, April 13. Okay, so we'll see what happens there. Warsh is probably going to be the Fed chair that's going to be speaking for the June meeting. FOMC meetings. Let me take a look at this thing over here. Meeting calendar. So we have April coming up. That's Powell's last meeting. Then we have June. Yeah. So Warsh is going to be there during that one. We'll see what happens. I mean, he's pretty dovish on rates, but he's not exactly dovish when it comes to the balance sheet, which means money printing. But we'll see what happens. As long as inflation is in tame, he's probably going to continue cutting rates. I'm seeing the market move a little bit here after hours. Let's take a look at the market after hours real quick. Over here. Yeah. So the market is down about 16 basis points. I mean, it's making its usual moves. VIX is at 30, so it's really not going to do a whole lot over here. AMD. Oh, wow. AMD actually bounced a decent amount to close. I was actually thinking about opening up some hedges here today, but I'll wait for a bounce if I do any. Yeah, no, I don't have any hedges right now. I'm just chilling right now. Got about 17% cash today after I closed the Marvell position at about break even. So I wish I was 100% cash like a lot of those people out there, but I was not. So, you know, it is what it is. It's just the nature of being in the market. I mean, it's all going to come back eventually. The question is, when will it come back? All right. So I don't know if you guys listened to a gentleman named Warren Pies. Warren Pies is an equity analyst and researcher. He does run money for he runs money for a lot of affluent people. I'm going to play this clip for you. It's about 4 minutes over here. Really good to hear this guy talk. In fact, this is one of the few guys that was actually very bullish in 2023. And he changed his stance recently, and it's interesting to hear his input on it. Let me go ahead and play it for you guys, and then I'm also going to share his Twitter handle in case you guys want to check his page out.
He's remain on downgrade watch for him, and the key will be whether this war heads into April. Joining me now is 314 Research co-founder Warren Pies. Warren, good to see April's coming fast. Obviously, it's next Wednesday, I guess. A week ago, you thought maybe you give it a week to see if we get de-escalation, the taco trade. So explain the thinking now.
Yeah, thank you for having me. I think we've, just like everybody, maybe we all learned the wrong lesson from last year, which is to wait and expect a capitulation and look for that off ramp in one of these kind of self-induced market sell-offs. But I think it's been prudent to wait and to let technicals guide you in this.
Oh, by the way, guys, this is from last Friday. Still relevant today since we closed basically flat in the day.
But we are getting to the point where the rubber meets the road. I think I do think there are signs that this sell-off is starting to move into the second phase, which is where investors are seeing that this is not a short-lived conflict. You're seeing the back end of the crude curve start to reflect a longer time elevated crude oil prices, and you're seeing some cross-asset moves. You're seeing gold rally. You're seeing the 2-year yields drop in the face of oil rallying and the stock market falling today. That's the first, I think, warning sign that the market's going to start looking through the inflationary first early impacts of this into the recessionary consequences.
Yeah, that for sure. I saw you highlight that today, which was significant, that there was a bit of a switch from how this thing has traded for the past few weeks. At the same time, you said, let the technicals guide you. I mean, we keep waiting for this kind of, people say whether we need some kind of a real flush, some kind of comprehensive liquidation. You see a lot of stocks trading at their lows. It feels like it sometimes does when you have some of that climactic action, but maybe not everything lined up.
Yeah, I don't think it's there yet, to be honest. I wish I could say that, but what we're knowing the oil market like I do, like we're looking down the barrel at a very, very serious situation. If this lasts, like Rubio's comments to the G7 today was, hey, 2 to 4 more weeks. If this lasts 4 weeks, the S&P 500 is going into a bear market. Oil will be at $150 a barrel. There will be shortages. I'm not trying to be an alarmist, but this is just, you need to be sober-minded about what you're facing down. And I don't see sentiment reflecting that yet. We look at managed money, or we look at inverse ETF volume. It's a lake where you'd expect to be for a run-of-the-mill pullback and things like that. But I don't see the real fear and panic. In the levels that we're talking about, we moved into this consolidation range where we lost momentum back in February. That's when we initially downgraded stocks. And we basically said, okay, we want to see this range resolve. And that range was 65.38 on the downside, 6,900 on the upside. We broke through 65.38. We're waiting to get some good closes, a weekly close below that. So I think you should expect the momentum to accelerate to the downside from here based on technicals and sentiment to me.
Yeah, I mean, you've made the point when it comes to oil, it's sort of a cumulative effect to some degree. We have this daily shortfall. We're kind of burning through reserves and releases, and there's some I guess rationing going on. But how does that snowball if we go 2 to 4 weeks?
Yeah, so to me, and we talked about this a week ago. So every day, I would say, just as a good rough estimate, and this includes the SPR release, this includes the bypass pipeline to the Red Sea from the East-West pipeline. There's still a 10 million barrel a day hole in the market every day, and that's with all the best assumptions I can possibly make. If we roll that forward 1 month, that's 300 million barrels that we lost. We can already see it's gone on the water. The water excess inventories are gone. Now we're cutting into onshore excess inventories. As we roll into April, you're going to draw below what we would consider excess. And then you move into, even if we get a resolution to the war and we open the Strait of Hormuz back up, you still have time to get production and lost refinery capacity back online. This tells me that best case scenario is we're going to lose 600 million barrels of inventory out of global inventories. That's about an 8 billion barrel storage globally. That's a huge number. That's more than we've ever seen in any calendar year on record. So that's in 2 months. We're changing the shape of the oil market in real time in a short 2-month window. Never seen anything like it before.
Yeah. So, I mean, the takeaway you want to have from that one, guys, is that if oil still stays afloat, we're certainly going to see continued down pressure on the market. There was actually some interesting price action today regarding oil because I've been looking at some oil over here. Hold on a second. Not that one. This one. All right. So if we look at crude, Oh, you know what? This isn't the same thing that I saw with you with XLE. Okay, so crude closed at its high of day. Okay, that's what we want to see. I forget about what I just said. That is not what you want to see over here with crude continuing to come up over here. But Warren Pies is basically saying that there's obviously a lot of constraint when it comes to oil as far as supply goes with the Strait of Hormuz, and we did have some continued development with the other strait that's nearby the Strait of Hormuz, which is getting a lot more oil supply as well. But if this price of oil continues to go up, that's going to strain all of the byproducts that are created using oil, whether it's machinery, whether it's plastic or anything like that. And also on top of that, we do have reserves that we did release some of them. But even if we did release these reserves into the open market, we do burn about, I think it was about, how much oil do we burn per day? Let's see here. We use about 20 million barrels of oil per day. Globally is 100 million barrels of oil per day. So like, even if it released reserves, it's not really going to do anything. So he said that if this war goes on for 2 more weeks, we're going to be in a bear market. And what we heard from the White House was today that the war is going to go on for a total of 4 to 6 weeks. We are in week 4 of the war, about week 4. And 2 more weeks, which is in line with Rubio was saying, would put us in that 6-week range of being in this war, which we don't even know if this is going to end anytime soon. So I think that is where kind of the constraint comes with one, inflation, because even if this war does end, inflation is still going to stick around because oil has been up for a long time. So I don't know. We'll wait and see. This is probably one of the reasons why I'm not like we're at a bottom here, because you're continuing to see oil plow higher. That's not what the market wants to see. So it's pretty interesting seeing that we were rallying to close, but now we're kind of giving up that rallying after hours. All right. So another clip that I did want to play for you guys is regarding Anthropic. So actually, there's one more I wanted to play besides that one. Where was it? I played the Moran one. Actually, no, there was not another one. For anyone that is a Rocket Lab bull, which is really already news that we knew about, but they did finally get the full-on approval of it. But we had that Rocket Lab. Rocket Lab received the approval to acquire Minarik AG, expanding it to Europe and strengthening its satellite stack. This deal adds high-speed laser comms tied to major defense contracts. So obviously, this is a story of Rocket Lab. You have already that they are a space platform to launch their own rocket ships. But in addition to that, they do build a lot of software as well. But they are continuing to expand further into defense. And that's kind of the reason why you're continuing to see Rocket Lab still be strong in the face of a market pulling back. It's down a good amount percent today, but still, I believe they are green year to date. Is Rocket Lab green year to date? Let's see over here. Is Rocket Lab green year to date? No, they're red year to date. But I mean, they went all the way to $100. So they were acting pretty nice earlier this year. ASTS, this is also another space play. This is actually still green in the year. Oh, I think it just turned red in the year today. But still doing pretty good. Do you see SpaceX considering not IPOing Unhood and SoFi? I don't know. I mean, I was actually very surprised to see that news this morning, because you would think that they'd want the exit liquidity to get a lot of retail in there. But if we take a look at the news I was received on SpaceX earlier today, no, that's not the one. There was some news regarding SpaceX. And all right, I can't find it. But they're considering not having the SpaceX IPO available to Robinhood and SoFi users. To be honest, that's probably a good thing. Why would you buy a $1.5 trillion IPO, which is obviously going to be oversubscribed, right when it comes out, when the market is going down? In a time when a market is falling like this, you don't buy IPOs, because IPOs make massive moves based on its hype. But if the market is pulling back, there isn't going to be so much hype when those happen. Again, Rocket Lab is probably your closest comparison when it comes to sales, when it comes to SpaceX that's publicly traded. Definitely not as big as SpaceX, because Rocket Lab is certainly not a $1.5 trillion company, but it's probably our closest proxy to it. So you saw a bit of the excitement with Rocket Lab when the SpaceX IPO was announced. Went to nearly $100, about 50% down since then. So if this hype wears down, you can certainly expect the hype with SpaceX to wear down as well, right? So we'll continue to see what happens there. Yeah, IPOs almost always go down. They do. A lot of IPOs usually go down. We've had more than a few of them happen. Actually, when ARM IPO'd back here, it rallied pretty high, and then it pulled all the way back dramatically, especially to last April. Rubrik was an IPO. I did buy very close to this IPO around here, and it went up, and then look, it's all the way back down here. And so that's certainly not fun to see. Oh, wow. Palo Alto's up 5% today. CrowdStrike's up 2.5% today. Interesting. Palantir is down over here today. It's pretty interesting. Was anybody buying some stocks today? I know I saw Ahmed. He was buying some Palantir. Oh, VCX. What's VCX doing? Wow. Down another 35% today. I would have loved to short this one, but there were no shares available to short this one. And I know Citron Research actually shorted this one. So that's pretty interesting to see. I mean, if you're chasing this one, I think hard lesson learned, I guess. Definitely don't. Yeah, he bought $10 million worth of shares. Probably why it's up. So we'll see what happens with that one. Starlink is 70% SpaceX revenue. It was actually pretty interesting. There was someone that was at the event which knew a lot about Starlink. Maybe I should have collected those details from him. All right. But anyways, I wanted to play a clip here regarding Anthropic and the continued fear of destroying software. And they did extend into destroying software in cybersecurity, which is pretty ironic to see that kind of stuff in cybersecurity, considering that you would think that as agentic AI and AI does get a lot better, that would make cybersecurity more important, right? At least that's what I would think it would. Maybe the market doesn't agree with me on that one, but I would think that that would be the case. So let me go ahead and play this clip regarding the AI disruption of cybersecurity from Anthropic.
Anthropic reportedly testing a powerful new AI model with more advanced cybersecurity capabilities. That news hitting the cybersecurity stocks last week. Seema Modi has the details in today's Tech Check. Hey, Seema.
Hey, Leslie, and there's a key distinction here. This is Anthropic's latest model, rumored to debut in April, and the expectation is that it will be more powerful and robust in nature, and according to reports, will lower the barrier, possibly to bad actors. Now, the CEOs of the world's largest cyber companies are calling on AI labs to be more responsible. Palo Alto Network CEO Nikesh Arora writing in a blog post this morning that a single bad actor will now be able to run campaigns that once required entire teams. Every desktop, he says, now effectively behaves like a server and is likely to have unsupervised AI tools operating near sensitive systems. The attack surface keeps growing, mostly unnoticed. Arora, who bought $10 million in Palo Alto stock last Friday, is calling on OpenAI and Anthropic to release these capabilities in a responsible fashion while ensuring the defenders have been consulted. The key question, Leslie, now for investors is if the large language models continue to enhance their AI capabilities and build offerings that are competitive to the software and cybersecurity vendors, will they replace these companies or they actually increase the total addressable market? Analysts at Wolf weighing in on this whole conversation, they think this only leads to more spending on cybersecurity. They're actually upgrading shares of CrowdStrike to $450 a share.
So that's something that I always found interesting. It's like, it kind of makes sense why you would sell, like why cybersecurity would sell off in the midst of a market falling. But to accelerate that sell off in response to this news, just see it's more like an excuse for deleveraging for institutions. That's the only way that I would see it. Valuations are, of course, pretty big for companies like CrowdStrike, which is traded like 16 times. In fact, I do have breakdown and valuations from Jam & Ball, who is part of Altimeter. Let me pull this one over here. He releases these articles every single week, which are really cool to read. He also releases these charts that shows the valuation of software stock. This is as of last Friday. So Palantir is trading at 47.8 times enterprise value, next 12 month sales. Cloudflare is at 26 times. CrowdStrike at 16 times. Datadog's at 10 times. Shopify 10, Palo Alto 9. Palo Alto's probably a little bit higher, is up like 5% today. DigitalOcean is a 9, Samsara is a 9, Guidewire is at 8. These companies, these top 10 companies are definitely going to be trading pretty expensive and definitely going to have heightened valuations because look at their margins over here. So gross margins for these software companies are obviously going to be in the high percentage wise because they're able to scale out and reduce costs. Look at these operating margins. Palantir is 32% operating margins, 47% free cash flow margins, and they're growing at 62% next 12 months. That's why this is expensive, guys. This is also the forefront of software AI, right? So there's hardware AI, there's NVIDIA, and there's software AI, which is Palantir. So it's going to have a premium. Cloudflare, which is more in the space of AI inference queries, providing that edge compute for faster response to queries, trading at 26.3 times EV NTM forward, gross margin 75%, operating margins, they are not profitable operating margins. Free cash flow margins 12%. So they have like a very wide moat because about 40% of all DNS traffic goes through Cloudflare. They are also protectors of the internet as well because they do block DNS attacks, DDoS attacks for a lot of companies as well. So they do have that individuality when it comes to edge computing. They are a dominant force there, but this trade's very expensive. I will not be buying Cloudflare at the current price today. Very expensive. CrowdStrike at 16 times with the gross margin 75. They are not profitable on an operating basis, but they have a 26% free cash flow margin. CrowdStrike is the leader when it comes to endpoint security client management. Okay, so that's the reason why they trade at a premium. Datadog is 10 times. Free cash flow margin 27%. Datadog is probably the one company where I'm like, why is it so expensive? It doesn't make any sense. Yeah, their management is a really good team. And by no means is it a bad company. It's a really good company. But they're more in the observability range. And when you think about compliance, when you think about the importance of having outsourced products for monitoring your own applications, just makes me curious, like, why would you have Datadog if you could probably build something in-house? Like, you're not going to build yourself an in-house cybersecurity product because guess what? That's a lot to manage. That's a lot of overhead to manage if you're going to be keeping this in-house, developing, making them better, and also catching all the latest definitions that are out there as far as reducing the amount of viruses and potential attacks. That's something that's a lot harder to do when you're talking about monitoring applications. Maybe having 1,000 licenses of Datadog with the max tier plan doesn't really make sense. Maybe like reduce that by about 10, 20%. And that's probably going to be enough for a haircut in terms of the growth with Datadog. We've continued to see that the last few quarters is that their net dollar retention has actually slowly subsided. But still, one of the best company when it comes to observability out there, and excellent company that's managed very well. But I wouldn't be surprised to see this come down to like 7-6 times, which mean like a 20-30% drawdown if this fear does continue. Shopify had an e-commerce payment platform. You guys already know about that one. Palo Alto is the dominant leader when it comes to cybersecurity as far as revenue growth, as far as revenue. And their free cash flow margins are 36% and 14% operating margins. But this is quite a mature cybersecurity company, so you're not going to get a double on it, right? But at the same time, probably one of the least riskiest cybersecurity plays out there. Snowflake, highly disruptive company. I do think that this one's potential for a lot of disruption out there. They are not operating profitable. They're not profitable on the bottom line. They have 24% free cash flow margins. I was a buyer of Snowflake when it was in the low hundreds and at $150 2 years ago. Would I buy Snowflake here? Probably not. I think there's a lot of disruption when you think about data processing, especially when it comes to business intelligence and all of that stuff. Like that is open for disruption. I would not be surprised to see companies start to build their own products out there to replace what Snowflake does. DigitalOcean, edge computing, this one has a lot of potential, but it's ran quite a bit, so I'd really hold off on that one. Samsara, IoT, Internet of Things. I don't really know exactly what they do, to be honest, but that stock's performing pretty decently lately. Guidewire, I don't even know what they do. But these valuations are still pretty excessive. So if cybersecurity pulls back here, if we get CrowdStrike in the low 200s, I'll be a buyer. Until then, probably not going to be buying CrowdStrike anytime soon. Rubrik is not in this list because the valuation is compressed quite a good amount. That's more in the data security. So I've talked about cybersecurity ad nauseum for quite some time. But speaking of being bullish stocks, we did, of course, and I think Amit was discussing this one this morning. We did, of course, have Bill Ackman basically come out with this tweet saying that there's a lot of stocks trading compelling valuations. The two big ones in his portfolio that are trading compelling valuations are Meta and Amazon. You saw those green today, basically. But I don't know. Bill Ackman is an interesting guy when he starts getting loud on Twitter. When Bill Ackman starts getting loud on Twitter, that means he's hurting, okay? That was a very short post we saw from Bill Ackman. 2 paragraphs. I still remember when he made his massive post during the bottom of the tariff tantrum from Trump. That was the bottom because he was flipping out on Twitter. This one, a little more confidence. So my Bill Ackman indicator does not show that we're at the bottom yet. I don't know. Maybe we are. Maybe we're not. But I do agree with them. There's certain stocks that are trading at really good valuations, which is the reason why I'm dollar cost averaging into it. Let me actually pull up the Bill Ackman tweet over here. I did post this last night. There we go. Yeah, so this is the Bill Ackman. This is such a short post for Bill Ackman, guys. He's not freaking out. He's not freaking out one bit. He's just saying that to ignore the bears. Like, okay, well, I want to see this guy like completely flip out on Twitter, and then it'll be time to buy. Until then, I mean, you're basically paying 2 and 20 to own mega caps. I mean, Bill Ackman's a great guy, but I don't see the point in pouring so much money to his funds. You could just buy his stocks. And he's not even like a trader or anything. He's a trader as in like trader, not traitor. He's not a trader. He buys and holds. So I mean, like, do you need to pay 2 and 20 for something like that to manage your money? I don't know. You could just do it yourself, save some money. But then again, I'm not managing billions of dollars. So what do I know? Some of the highest quality businesses in the world are trading at extremely cheap prices. I don't think they're trading at extremely cheap prices. This is in 2022. They're trading cheap. They're not trading at extremely cheap prices. Ignore the MSM. What does MSM mean? May I meet you? Nice. You know what? Call it. No. That's not what MSM means, but not nice one. What does MSM mean, Bill Ackman? Mainstream media. Okay, he's got a point there. You do have to ignore mainstream media when it comes to that one. One of the most one-sided wars in history. I don't know, man. It is very one-sided, right? We could end it, but that doesn't mean it's going to end anytime soon. So I wouldn't downplay the war or anything. That will end well for the U.S. and the world. Again, I think there's going to be more of a taco here than anything. I don't think things are going to end well. The only way to really end this is to pull out of Iran and declare victory, which we know is not going to be a victory. And we have a large potential for world peace dividend. We'll see. He sounds very confident here. One of the best names in a long time to buy quality. Okay. He does make a lot of sense here. When you're buying long-term, you don't buy meme stocks. Meme stocks is not a good long-term investment. Meme stocks is a good trade, not a long-term investment. Because I don't know if Beyond Meat's going to be around in 10 years. I don't even know how it's still around right now. And that is a meme stock. That is not quality, and that is not what Bill Ackman's telling you to buy. He's telling you to buy Amazon, Meta, Google, whatever's in his portfolio. Let's see actually what's in Bill Ackman's portfolio. Bill Ackman's 13F. So he has 11% weighting in, actually, let me do it by weighting. 18% in Brookfield. He has 16% in Uber. He has 14% in Amazon. Is that right? He only has 14% in Google? I thought he had more than that. He has 11% in Meta, QSR, Howard Hughes, all that stuff. He still holds STZ. He sold out of Chipotle before. He actually made a lot of money in Chipotle. So, yeah. I'm very into Nebius. Am I buying Nebius here? Probably not. My average is pretty low. I was actually looking to sell some puts in Nebius, but probably not a good time to do that, so I stayed away from it. Brookfield is actually the most interesting one that I don't own on here. Really good long-term play. That is quality, my friends. Brookfield is a very good quality company. Wow, that's trading at $38? Interesting. What is the chart looking like in this beast? Below the 200-day moving average. Okay. No, not really looking good. Yeah, Brookfield's a pretty interesting one. You got a nuclear play in here. You have real estate plays in here. They own so many properties around the entire world. So many buildings. We'll see what happens. Zeta. Someone asked about Zeta. Oh, yeah, they're green today. IGV was green today, so didn't mind that one. Is this a dead cat bounce? I don't know, guys. I have no idea if this is a dead cat bounce or not. But yeah, that is Bill Ackman for you. We will see what happens there. Let me actually pull up something here because I want to see if CNBC is doing something crazy on TV right now. And then I'm probably going to end the stream. Stephanie Link was on CNBC. Stephanie Link is cool. I like Stephanie Link. Hold on. They usually have something good in the closing bell, but I don't see any guests on here. No, nothing there. Who's Scott talking to? Oh, Tom Lee was on today. All right, cool. So I want to play this one for you. Let me just get the beginning of this clip. I did not know Tom Lee was on here. All right, here we go. This is going to be interesting. I didn't listen to this one, so this is going to be interesting to see what he has to say. Hold on. Let me make sure I'm sharing the sound. I don't want you guys to yell at me. All right, good. Sound is on.
He's also a CNBC contributor back here at Post 9. It's good to see you.
Great to see you,
Right, just to remind people, you're like, we're going to get off to a good start. I think we're going to have a bear market at some point this year, and then we're going to have a strong rally and finish well. As I mentioned, obviously, you didn't have this on your bingo card. You thought maybe it was going to be issues around a new Fed chair, et cetera.
Yeah.
So with that as the context, what do I do now?
Well, I think markets are in the process of discounting a lot of the bad news because the war isn't quick and there's risk to the oil supply disruption. And I heard a lot of our clients kind of worrying what it means for the economy and for GDP. But I think that means the market now can respond to less bad news. And I think one of the less bad things is it's possible earnings estimates should be going up right now, even with higher oil. It's because of the defense spending. If we're spending $200 billion a month on war, Department of War, that's $2 trillion a year incremental. Every $10 rise in gasoline or oil is $70 billion a year. So even if $30 oil rise is $200 billion, it's more than offset by defense spending. So I think markets should start to sort of front load this discounting and we could start rising.
I think that's the critical thing that people are trying to get their arms around of all this, that the reason why people haven't gotten, in mass negative and the market hasn't looked worse than it's traded, albeit down 5 straight weeks, is believing that the earnings story is going to stay intact and that it's going to remain resilient. But even those who think it's going to remain resilient are pointing to places that are not the defense area and convincing themselves that it's going to hold up. Do you believe that?
Yeah, I mean, we are in a fog of war, so I can't say things definitively, but we do know that after 5 weeks, we can see how markets are letting things outperform, and outperformance is energy, rate sensitive, which is utilities, treasuries, and financials, but it's also large cap tech and crypto. So I think in some ways, the market is betting that growth is going to hold up in the U.S.
Would you buy the market today?
Yeah, I think we're 90 to 95% through the sell-off.
Why? This is one thing I don't understand about Wall Street analysts, to say that they believe we are X% at the end of the sell-off. Because what if we're not? Well, you just said we're almost done with it, right? It's just like, I will never, ever tell you guys that I think the sell-off is done or I think the sell-off is almost done, right? I'll tell you guys when I think it's done after we recovered for a little bit. But when we have a falling knife like this, like a falling freaking knife in the stock market, like, why are you calling the bottom? Like, I don't know why. I don't know why. Handed though, Tom Lee's been right for a long time. The unfortunate part is that he's been wrong lately, especially things he's been pounding the table on. That's probably the reason why a lot of people are hating on him, because of the fact that he has been wrong, not only recently, but at things that he was very bullish on, like BM&R. So, this goes to show as a learning lesson. And I've done it myself many times too. In fact, I've done it recently as well, right? Don't borrow conviction from people. If people are very bullish something, don't just buy it because this person said it. Buy it because you did your research, you built your conviction on it, and you believe the long story is going to work out. So you're going to buy it because of that reason. Because when it falls, you're going to feel like crap. Oh, I shouldn't have listened to this guy and bought the stock. It'll be more of taking accountability. I bought it because I believe it, and I'm going to continue to hold it because I still believe in it. If you don't believe in it anymore, don't hold it. Don't average down on losers if you don't believe in it. That's all I got to say about this. We'll listen to this rest of this one. I'm going to be a few more minutes on. I'm going to end the pod because I got to get ready to go to Egypt.
Gives you that confidence?
Well, I think some of it's positioning, and Goldman had a really nice piece about hedge fund positioning.
That's right.
And
certain things that looked up, sorry to interrupt you, just so people have the full context. Their note was basically like, look, we've observed a lot of hedge funds selling, which looked like capitulation activity to us. So maybe that's run its course. So now you can perhaps build that base back up.
Yeah, so I think that's one component. The second is retail sentiment's very negative because the AAII bulls less bears is -20. That's a tactical sign. The VIX closed above 30. And now I think earnings season is going to show earnings probably going to hold up better. And then the last piece there is I think we're just going to have to realize that stocks tend to bottom early in a wartime situation. So we've looked at every war since 1900. Stocks will bottom within the first 10% of that war. So if this is a, 2-year war, we're going to bottom pretty early into that process.
So let's hit tech more broadly, because it hasn't traded well and it hasn't really shown any signs that it's finding its legs. Like you had memory names, for example, last week look horrific. And what does Micron do today? Let's show it. Ugly again. There's like it doesn't feel like there's an ability for a stock like that in a group that went straight up and to the right to find any stability there. Mega caps, they haven't looked great at all. And the only thing I can find people saying good about them is, well, look at their multiples now.
Yeah.
They've compressed a lot in the pullback.
Yeah, we're in the fire ready aim phase, right, where any little bad news is going to cause people to de-risk. But as you know, that's why the positioning is something to watch, because at some point people have gotten too neutral and then less bad things can happen and the market has a V-shaped recovery.
If you were inclined,
this is something that I again don't get. Okay, there's words that people can use when they're on TV that can make people very anxious and want them to buy now, right? When you say that the market's close to the bottom, people get anxious. It's like, okay, so I want to buy now because I don't want to miss the bottom, right? And he also just said, like, people get anxious because they don't want to miss the recovery, right? Like that, the statistics where it goes, like, if you miss like the 10 best days in the stock market in the year, you're going to lose like half your gains. Or you're going to miss out on half the gains, which is true. It's true. But, that doesn't mean you need to like liquidate everything and then buy everything and time the bottom. It just means like, don't get aggressive when markets are falling off cliff. I prefer to like more buy the recovery than anything versus trying to time the bottom, because I thought the bottom was 5% ago, but I wasn't like, this is the bottom, guys. I just mentally thought, maybe we're at the bottom of the range. We've been trading sideways around for the last like 5-6 months. Maybe things are going to be kind of bottoming out here, and it didn't, right? And I'm glad I didn't like buy hard or anything, because if I did, I would have been toast right now. Not the stock TOST, but like toast.
Trying to buy, like you say you are, would that be the first place you would look, tech or somewhere else?
Yeah, I'd look at what's been strong already. And to me, because they've already had a rolling bear market, so I would say the Mag 7 should be leading, large cap tech. The semis I know are breaking down, but they've been leaders. I mean, even after this pullback, they're up over 70% year over year. And I think crypto is going to lead as well.
Why so?
Well, crypto is proving to be a good wartime store of value. So I think if people have been over allocated to gold, which is underperformed, and they're looking for stable value, especially high net worth families, I think they're going to allocate towards crypto.
What about financials, which have gotten hammered too? Like, this is another area that I hear people suggest it's going to be hard for the market to do a lot as long as financials remain a question mark.
Yeah, I listened to Fed Chair Powell speak today, and I think private credit has been maybe the thing that's been causing financials to weaken. And if Fed Chair Powell is correct, I mean, the private credit is isolated, and that means financials got too cheap.
Well, I mean, isolate is a relative word. I mean, I think people are worried that it could still get a lot worse than it is now, but there's a difference between that morphing into something systemic, which the chair said, along with many others who are much smarter in this space than me, don't think it is.
Yeah, that's right. Private credit, it's actually pretty big. It's about the same size as high yield, but it's not as widely held as mortgages were and for retail. So this is going to end up being an issue for high net worth families and allocators, but that's different than one causing widespread damage.
All right, Tom, thank you. We'll check in with you again soon, I'm sure of that. Tom Lee. Up next, we track the biggest movers into the close today.
Oh, that was really it with that one. You guys are gonna definitely enjoy Amit tomorrow and the rest of the time. There's not another meetup until May. Let me actually pull up. Let me actually pull up the calendar that Amit has real quick. All right, so we have. Hey, look at that guy over there. That's me. All right. Let's see. So we had the LA meetup recently, Chicago meetups on May 9, Singapore meetups in June, UK meetup in August, Austin. I'm probably going to be at the Austin meetup. I don't think I'm going to go to the UK one, but I am going to go to the Germany one. He didn't list that one on here. Oh, wow. Sitting down with leaders. I don't think. Oh, okay. He already did do the Brett one. I thought he was going to have that on. Hold on. He's a scout for Ace 167. Okay, yeah. I thought I saw. Germany on here. I don't know when Germany is going to be, but I definitely would like to go to that one. But yeah. All right, guys. I think that's about it for the show. Really great to see you all if you were at the meetup last weekend. Looking forward to the next one. I'm not going to be able to go to the Chicago one. Again, I'm not going to be doing the streams, the intraday streams. I usually do it around 2:45 for about an hour before Amit goes live for the close. I'm not going to be doing that one the next couple of weeks. I'm going to be overseas. I'm going to be in Egypt. Hopefully, I'm going to be going to Jordan. If not, then that would mean that plane trip is canceled, and I'm probably going to have to divert and probably just go to Italy at that point. Yeah, I'll keep you guys posted. I'm still going to be live on the Twitter. I might record a video or two and post on my YouTube channel, but it'll be very difficult to do any live sessions. They're like 12 hours ahead. So what is the time in Egypt over here? Time in Egypt is 11 p.m. In LA, it is 2 p.m. So they're like 10 hours ahead. No, I can't even do math right now. They're 9 hours ahead. Right. So what a fun day to lose so much money. What a fun day. Amcor is down 7%. On Semiconductor is down 5%. Hood is down 1%. These are big positions in my portfolio. So today was not a fun day. Micron is down 10%. I don't know, guys. We'll see what happens. Maybe we are at a local bottom. I thought we were going to be green today. We did not end up green today. We sold off pretty handsomely as soon as the market opened. Haven't really turned back since then. So hopefully we get a little bit of recovery here. Amazon was up about 1%. Meta's up about 2%. Someone asked about Microsoft. Microsoft is up about 60 basis points today. But Microsoft is literally trading at where it was trading last April. Anyways, I added money to the account, but I didn't execute those orders yet. So I'm probably going to do those after I just buy a few of these mega caps right now. Some companies I'm probably going to be adding to the DCA. Again, DCA, like slow dollar cost average for me. Just going to be just doing this until God knows how long. Once the market starts to get bullish again, I'll probably stop the DCAing and probably start to look to be more tactical. Until then, I mean, if we are really going to be 30% down, just like Citrini said, we're going to be like 30% down this P500 in 2026 or 2028 or something like that. I mean, hopefully not. But always look to the bright side of things, guys. I mean, if you're invested for the future for decades, then you have to get used to this stuff. You have to get used to bear markets. You have to get used to pullbacks. You can't be long-term invested in the stock market and think the market goes up every day. Everyone knows that. But being in the situations where we are having the bear markets or we are having the corrections and stuff, that is the part that's very real. And right now, I don't think we have capitulation yet. Capitulation usually happens when you see like that massive sell and everything is being sold off. I don't see that yet. I don't see that capitulation yet, where like the selling really happens. And unfortunately, it's hard to determine the bottom when that happens. But the good part is that if you are buying in size in the recovery, then you don't really need to worry about calling the bottom. You're not going to catch the bottom, but you don't need to worry about the bottom, right? So that is my take on it. At the same time, dollar cost average, you have a 401k and so on. Don't liquidate all your stuff thinking that the market's going to go down lower, because time out of the market is never as good as time in the market. It's timing the market is not as good as time in the market, right? I'm invested all the time, right? And this is probably the most amount of cash I had in a while, especially since last April. I'm at 17% cash right now. Definitely red year to date. I think I'm like 15% down year to date or something like that. The hedges, I did have some hedges a couple weeks ago and should have held those. Should have, would have, could have. But really, it's about the long term. So, if you're playing with money and you expect to get rich in next week by buying the dip and calls today, think again. I would be very careful to do that. It's a serious thing, so you got to think about your mental capital and your mental perseverance as well. I mean, if you are out there trying to call the bottoms, buying, selling, then that's going to be strenuous on your mental fortitude, right? So that can be very stressful. I've been in those situations before, especially during COVID. It was not a fun situation in COVID, but that was a long time ago, and I learned my lesson. And now it's just being more patient. Being more patient is the name of the game as it is right now. So anyways, guys, thank you very much. Really appreciate you guys being here. Again, if I met you last Saturday, really great time to meet you. Met a lot of cool people last Saturday. Saw Davis again for the second time. He really is, Davis really is a voluntary hobo. Like, I don't know why this guy bought Palantir in the single digits, but he still sleeps on people's couches. Like, I don't get it. I don't get it. But anyways, good to see him. Good to see you guys too. Looking forward to the next meetup. Again, probably not going to the Chicago one, but obviously there's gonna be a lot of people there. Nate lives in Chicago. A lot more people who are on the East Coast are probably gonna go to that one. But it was really a good time, guys. Really enjoyed hanging out with you all. It was also really cool to like talk more than just being on the screen, streaming here and there. Like actually talk about personal stuff too, which is really cool. Because we all have personal lives outside of this, so keep in mind to enjoy your lives, even if you're in like a 20-30% drawdown. It is what it is. Take it as a learning lesson, and then executing those learning lessons next time, right? To not make the same mistakes over again, because this is a long haul game. This is a game where it is a marathon. It's not about getting rich overnight. It's not about pumping calls overnight and hoping you double, triple the next day. There is a time for that, but the time is not now. The time for that is when we have a massive recovery and things are great. That is the time when you start increasing risk, or at least when I do. Right now is not a time where I increase risk, because you can go broke very quickly trying to call the bottom here, right? So just be very careful, guys, out there. Enjoy your lives. It's only Monday. For me, it feels like it's the weekend because I'm about to leave. But yeah, really appreciate you guys tuning in. Take care. Amit, of course, will be back. Market close, market opens. I'm still going to be watching. I'm still going to be in the chat. Won't be doing much of the streams. I really appreciate you guys. Again, the Chris Camillo interview is on the Wolf YouTube channel. Go ahead and check that out. I'm going to be listening to that one during my flight. I got a 13-hour flight tonight. 13-hour flight. So that's not going to be fun.